All right, let's dive right in. If you're looking for a really safe, reliable way to grow your savings, you've probably heard of these two heavyweights, fixed annuities and certificates of deposit, CDs. Today, we're going to put them head to head, a little showdown to see which one might be the right fit for your money and your goals.
I mean, this is the big question for anyone who's a conservative saver, isn't it? You want your money to grow, for sure, but you absolutely, positively do not want to risk losing the principal you've worked so hard to save up. This is where protecting your capital is, well, it's everything.
So let's meet our two contenders. On one side, you've got the fixed annuity. Think of this as an insurance product. On the other side, the good old certificate of deposit, a classic product from your bank. Now, both of them promise you guaranteed rates, and they both give you that peace of mind that your initial investment is safe. But, and this is a big but, the way they do it and the other perks they bring to the table, they are worlds apart.
All right, let's start with the fun part, growth. How do these two actually help you make more money? We're going to look at the interest rates they offer and, maybe even more importantly, how taxes, how Uncle Sam plays a role in all of this.
When you put the rates side by side, you start to see a pattern pretty quickly. Fixed annuities often, and I mean often, have the edge here, especially if you're willing to lock in your money for a longer term. With a CD, when it matures in, say, a few years, you've got to renew it at whatever the current rates are, and who knows, they could be way lower. An annuity, though, can lock in a higher rate for a much, much longer time.
And here's where we see a huge difference, tax-deferred growth. For annuities, this is a game changer. Imagine a snowball rolling downhill. With an annuity, it just keeps getting bigger and bigger because your earnings get to compound year after year without a tax bill slowing it down. With a CD, on the other hand, you get this little tax drag every single year. You have to pay taxes on the interest you earn, even if you don't touch it, and that can really eat into your growth over the long run.
Growth is awesome, no doubt, but what happens if life happens? What if you need to get to your money unexpectedly? That brings us to our next big point of comparison, flexibility. How easy is it to access your cash?
Now, both of these have penalties if you cash out early, let's be clear. But fixed annuities usually have a really nice feature built in, kind of like a little escape hatch. A lot of them let you pull out a chunk of your money, usually around 10%, every year, with no penalty at all. CDs, they're generally a lot stricter. If you touch that money before its maturity date, you're almost certainly going to forfeit some of the interest you've earned.
So we've talked about growing your money and getting to your money. But what about the end game? Let's zoom out and look at how these products really perform when it's time to retire or when you want to pass your savings on to the people you care about. This is the annuity's superpower. It's something a CD just can't do. You can take that whole lump sum you've grown and, with the flip of a switch, turn it into your own private pension. You can create a guaranteed paycheck that shows up every month for a set number of years or even for the rest of your life. It's an incredible way to protect yourself from the fear of outliving your money.
And what about leaving a legacy? Well, the differences just keep on coming. With an annuity, the money can go directly to the person who named as your beneficiary, completely skipping probate. Probate, that's the long, often public, and sometimes costly court process to settle an estate. This means your loved ones get the money faster and with a lot less hassle. CD, well, it's part of your estate, so it's probably heading to probate unless you've set up some specific legal workarounds. All right, we've gone through growth, flexibility, and the endgame. Now it's time for the most important question of all. Which of these tools belongs in your financial toolbox? A fixed annuity really starts to make sense if you're playing the long game. So if you're thinking about retirement income, if you want to lock in the best possible rates for years to come, and if you love the idea of that tax-deferred compounding magic, this is a really strong contender. It's built for stability and creating that predictable future. But a CD? That could be just the ticket for your shorter-term goals. Let's say you're saving for a down payment on a house in the next 2 or 3 years. Or maybe you just want the ironclad security of that government-backed FDIC insurance for a specific pot of cash. The simplicity of a CD can be exactly what you need. So, here's the real takeaway. This is the crucial point. There is no single winner here. It's not about which one is better, period. It's about which one is better for you, for your goals, and for your timeline. One is a retirement tool, the other is a savings tool. They're just built for different jobs. And that really just leaves us with one final question for you to think about. Before you can pick the right tool, you have to know what it is you're building. Are you building a steady income stream that's going to last the rest of your life? Or are you just saving up for a big purchase that's right around the corner? Answering that question is the first and honestly the most important step of all.